Okay. Hello. Good morning. I'm not sure which. Okay, we'll use this. This is good. Well, greetings everyone. Thanks so much for having me back. It really is an honor. And I'm going to talk about the U.S. economy more broadly, and my colleagues are going to delve more deeply into the regional and city and state and local aspects and things that are of interest. So I'm only going to be up here for 24 minutes and 51 seconds. All right. So let's make it good. So here are the big mega trends. So I'm just going to go through these, and this is what I'm going to talk about. After that, you can go and look at your cell phones. I don't mind, but I will show some pictures. All right. So what are the big mega trends for the U.S.? So inflation, so prices, what the Fed's going to do, monetary policy, and risks out there of a slowdown. Now, I know last year I said there was a slowdown coming. We didn't get it, which is good, but we may still see a slowdown a little bit this year, but really seeing the economy take off at the end of this year. When we ask consumers and CEOs of businesses what they think, we're getting mixed signals, but businesses are a little bit more optimistic, and consumers are a little bit more concerned about what's going on. So we're getting mixed signals there. But the good news is that inflation, which is the rate of change in prices, is slowing. Yeah, eggs are expensive and they're going to be that way. But instead of going from, $2 to $6, maybe they'll go to 7 as opposed to 10, right? So that's good news for consumers, but also for businesses. In terms of interest rates, like I said, we're probably going to see slower growth in the second and third quarter of this year, but then we'll improve certainly as the Fed cuts interest rates. We think they'll start reducing interest rates probably around June, which will be good news for the economy. And that's prefaced on the fact that both we and the Fed think that inflation is going to continue to slow, and it's going to get back to the Fed's 2% target probably around the middle of this year or the second half of this year. So that's all good news. Some challenges here. Labor markets are probably going to remain tight in some industries. And so that means that there's going to continue to be some wage pressures that resist what the Fed's trying to do in terms of tackling inflation to the ground. So we do think that the Fed has space to cut interest rates probably by about 2.5 percentage points over the course of this year and next year. But that's a little optimistic, but still in all, we're going to see lower interest rates. But where they end is probably going to be higher than what we're used to, higher than the interest rates we saw before the pandemic, in that space between the Great Recession and the pandemic itself. So get ready for higher borrowing costs, but that's mainly because we're going to continue to see upward pressures on inflation, some of which are going to come from ongoing challenges in the labor market, where we have more jobs available than we necessarily have people. And then there are a bunch of risks out there that I see that we can talk about a little bit later. But there's some things that are also pretty good. So I'll try to end on a happy note, not, okay, because I am the dismal economist. I like to depress people. All right. Okay, so let's take a look at some pictures. Okay, this isn't a picture. It's a lot of words, but the I always forget this is here. But basically, this is just telling the story of the last 4 years. A lot of it is about prices and inflation. And we've had lots of different shocks that have moved inflation up and down. So, of course, we had the pandemic that started here in the US in 2000. We had a global shutdown. We had a lot of volatility, and we saw people mainly just buying goods. And so there was strong demand for goods, but we didn't have enough goods. And also, it was tough to move the goods from across the world to the United States. And even once we got them here to the United States, we didn't necessarily have people to move it around the country. So we saw very high prices associated with goods. And then we had the war in Ukraine. Some people might say, well, how does that impact us? Well, Ukraine produces a lot of food and also some metals, and then Russia produces a lot of energy, and Russia was embargoed. So we saw food and energy prices globally rise, and it came back to haunt us here in the US. So those things really mattered. And so we had a big surge in inflation, and then we also had, due to these shocks, and then we also had a lot of natural disasters, which destroyed crops, and that also raised food prices. And then amid all that, we had the great reshuffling or the great resignation where everybody quit and went and found a new job. But during that process, that causes wages to be bid up. So we saw wages rise. So we had a lot of inflation. And so what did the Federal Reserve do? They said, well, we're going to raise interest rates very quickly, very high, to bring inflation back down to the ground, back to 2%, which is their target. So what does that mean? It takes a long time for interest rate hikes to filter through the economy. The first place we see it is in housing, right? So we did see the housing market around the US slow pretty dramatically. Then the next step is the impact on businesses, because all of a sudden the cost of capital rises. And also, if you have any debt, that debt service becomes more expensive. And so businesses pulled back. So the last piece of the puzzle is really the consumer. Consumers have spent a ton of money. Some of that was because they had stimulus checks. So people at the lower end of the spectrum spent it right away. But the people who were probably towards the higher end of the spectrum who received checks held on to it. And then they went on 3 vacations last year. I know I went on 2 vacations, but I didn't get a check. So, okay. So that was just like revenge spending for me. But the point is that you had a lot of that, what we call excess savings that people spent. And then also because lots of people quit and found jobs that were better and higher paying, they had a boost to income. And then last year, even though most of the companies that we talked to said they believe a recession was coming, they did not let anybody go. They held on to their workers because they said, look, we just went through this whole process of bringing people back, paying them more. If we let them go and then we have to bring them back 9 to 12 months later, we're going to have to pay them even more, right? So let's just hold on to everybody. So even though they thought recession was coming, they changed their behavior. So many people continued to work last year, except in a few industries where, certainly the tech sector, where there was right sizing. So the tech sector hired lots of people, probably more than was necessary, and then they kind of right size. But for the rest of the economy, most people just stayed employed. So that also helped out with consumption. But we think that consumers are probably running out of room. Why do we know this? Because lots of people are using their credit cards to fund their purchases, and credit card debt has risen, and the cost of carrying that debt has skyrocketed. And I have a picture of that. So with all that, and that's part of the plan. The Fed wants people to stop spending as much because that helps bring down inflation. But still, it's going to slow down the economy. But the Fed doesn't want to over tighten or cause the economy to go into recession. So they'll probably start cutting later this year. But we're going to have this kind of soft patch. So okay, now we have pictures. So this is a picture of inflation. So this is the personal consumption expenditure deflator. It's a lot of words, but that's basically what the Fed looks at in terms of inflation. So overall, which is a solid line, inflation is slowing. We topped out a little above 7%, and now we're around 2.9%. And the dashed line is the total less food and energy. So why do we take out food and energy? Because it's very volatile. You want to see what's going on underneath, but that's also slowing, right? So the good news is we're seeing slower inflation and we're getting close to 2%, where the Fed wants us to be. So this is a really colorful chart, but let me just walk you through it. So I took that inflation measure and broke it up into pieces. So we have goods on one side, services on the other. On the good side, you can see those green bars that were really big on the positive side. That was energy. And the yellow bars were food. And I don't remember what the blue bars were. Whatever it was, all those things have shrunken. And now you can see that there's just a little bit on each side of the line. So goods prices are kind of offsetting. So it's netting out to zero. So most of the inflation is in services. So those giant blue bars that look like Smurfs, if anybody remembers Smurfs, your kids probably do. That's shelter costs, right? And those shelter costs are a big chunk of why prices are as high as they are. Inflation is not yet at the 2% target. But the good news is that if we look at those shelter costs against a measure of home prices, the home price index is telling us that those shelter costs are going to come down. So that's going to be a really big chunk, and that's going to help shrink those blue bars, hopefully down to something that's more manageable and help us get back to 2% inflation. But the rest of the colorful bars, a lot of that is rising due to wages, wage pressures for services, and also insurance premiums. So if you notice that you have to pay higher insurance for your car and your home because cars are more expensive, more high tech, and when it comes to homes, we're experiencing more climate events. And so insurers are like, if we are going to insure you, you're going to have to pay up. So those are the things that are placing upward pressure on inflation. But the big thing is the housing element. Those costs are going to shrink, and that's good news. Okay, so this is what the Fed did. So this is the Fed's main policy rate. And you can see that between 2022 and now, which is a solid blue line, they raised rates very quickly and by a lot. Typically, it takes them several years to get to a peak, but they got there in about a year and a half. And the good news is they're signaling that they're going to cut interest rates this year. Right now, they're saying maybe we'll cut by 75 basis points, which is, most people think that's about 3 times this year. We think they can go a little bit more, maybe 4 or 5 times. It really depends upon inflation. But the good news is that interest rates are going to come off. But are we going to go back down to the average of the period between 2016 and 2020, which was around 1.5%? Probably not. We're probably going to end up probably between 2.5% and 3.5%, but certainly not 5.25%. So this is our forecast for inflation. So you could see we reached a peak in the second quarter of 2022, and it's going to come back down to 2% and kind of hang out there around the middle of this year. So that's good news. I'm telling you all good news. All right, so this is what I was talking about in terms of consumption. So this is contributions to GDP growth. And GDP is just basically adding up all the spending in the economy, what consumers spend on, what businesses invest in, what the government spends on, and what foreigners invest in the US. And the black and the red bars, that's consumer spending on goods and services. You can see that those 2 bars plus government and government spending has been, which is the light green bar, has been very substantial since we had investments in infrastructure and chips, et cetera. Those 3 bars represented most of the growth in the economy last year. So we think that certainly the consumer aspects probably isn't sustainable. So here we have income, which is the black line, and then we have spending, which is the blue line. So for a lot of last year, people were spending more than they had an income. That's not really sustainable. We saw spending come down a little bit in the last couple of readings, but still above income. So we think that's got to shrink back. And then, as I mentioned, people are putting a lot of their spending on credit cards. So we can see the black line, that's a consumer credit outstanding. So that's the total level of debt. And that really skyrocketed, right, starting around 2021. And then the blue line, that's how much they're paying in interest. So that skyrocketed too. And I'm sure a lot of consumers are going to say, hey, we have to pay this back. So let's pull back on the spending. So, and then when we look at how many consumers are falling behind, we have some delinquency numbers for consumers. For credit cards, it's well above the 2019 level. So a lot of consumers are falling behind. So that's not a good thing. So we think all in all, that's going to cause GDP to slow. I would say between second and third quarter, it's probably averaging out. Our newest forecast averages out to about 0.5% of growth over that period. So it's not negative, it's not zero, but it's not great, right? But then we get better later on as the Fed starts cutting interest rates. So let's talk about the labor market a little bit. So here I have a picture of payroll gains. So every month, the Bureau of Labor Statistics tell us how many people companies hired or fired, and then they net that out. And if it's positive, you get this, right? So the blue bars show us how much 3 industries have contributed to job additions every month. So the 3 industries are leisure and hospitality, healthcare and social assistance, and government. And since probably June of last year, those 3 industries have added the most people. and contributed to those outsized readings we see on payrolls month after month. But the gray bars are everybody else. So there's really not much in the way of hiring elsewhere in the economy. So you can imagine if those three groups run out of job openings and desire to hire people, we're going to see some weakness in the labor market. So this chart is a little tough to see. It's just a breakdown of the previous chart. But I wanted to show you guys this because the black bars are information. So that includes a lot of tech jobs. So yes, we did see right sizing and layoffs last year. But it looks like for this year, we're not seeing that much. So maybe that's over, and that's good news. Okay, this is probably more interesting for the next group who's going to talk about construction. So residential construction jobs have additions have basically gone to zero. So those are the yellow bars, they just kind of disappear. But you see a lot of construction jobs for heavy and civil engineering, which is a lot of that's infrastructure, and then non-residential building, a lot of that is factories. And so that's all related to the industrial policies of the current administration, which has invested in infrastructure and encouraged companies to bring their factories back to the US. So there's been a lot of factory building, a lot of infrastructure building. And that's, so that's a lot of that's been public and private partnerships. So that's actually good spending. That's the kind of spending we want the government to do because it increases productivity. So just think about it. If you're running a business and you don't have to change the tires on your trucks because the roads are so bad, that's great for you. It lowers the costs, right? And it's also good for your customers. So that's good news. Um, um, while companies haven't really been letting people go, and they have been raising wages, we can see that where wages, average hourly earnings now are a lot higher than the average that we saw between the great financial crisis and the pandemic, which was just below 3%. And right now we're above 4%. So wage growth is still really robust. That's great for your customers, not so great for you as business owners, right? So that's a risk for you guys. And here's just some breakdown. And so you can see that at least for a lot of services occupations, wage growth has slowed. For other occupations like the red and the green lines, which many of those are jobs that you have to physically show up to work for, wages are still rising. But all in all these wages are still well above where we were before the pandemic. So we may not go back to a period of very low wage growth. And this is just a survey that we asked CEOs of large companies. What are you thinking about in terms of raising wages over the next year? Most of them still say between 3 and 5%, which is a lot. And I even asked a bunch of CFOs last week that I met with, and they said the same thing. So their bosses and the CEOs and CFOs are saying the same thing about wages. Now, just thinking about labor shortages, they're not that acute in the information sector. So the blue bar is the maximum number of job openings, which was back in March 22. And the navy bar is pretty much now. So it's not terribly different. So there's not a lot of labor shortages. But going forward, there's still going to be tremendous demand for tech jobs because everything we do, everything we buy requires tech. So that's good news over the long run, even though during the short run, we're seeing some difficulties. And the point here is just that while companies are raising wages and holding on to people, they are cutting hours. So something's got to give. But the good news is that we don't expect the unemployment rate to rise very much. So we think it's probably going to get to around 4.2% by the end of this year and kind of hang out there, which is great. That's actually below the optimal level of employment, right? Of the unemployment, the natural rate of unemployment is like 4.5%. So if we land at 4.1%, that's still a really great labor market and certainly doesn't look like what we saw during the pandemic or during the great financial crisis where it took 10 years to recover all the jobs lost. So we're looking at a pretty good labor market outlook. That's the good part. The bad part is that it's going to be more expensive for firms because of wages. And indeed, when we ask companies, as I mentioned, what are you thinking about in terms of employment, we did see a little bit of a tick up from the end of last year to the beginning of this year in terms of those saying that they will cut workers. But it's still overwhelmingly the case that businesses are still hiring and that you have a bunch who are just kind of holding on to their labor. That's a little change. We call that hoarding or retention. And so that's going to continue to prevent the labor market from going under and keep the unemployment rate low. But there's still this issue with labor shortages. So how do I know that there are labor shortages? Well, there are a number of measures, but this one is the labor force participation rate. And I split it into two groups. So we have people 16 to 64. So that's the navy blue line. So that's recovered to where we were before the pandemic. That's great. But when you look at the light blue line, that's people 65 and older. So they dropped out of the labor market. They retired early during the pandemic, and many have not come back. And that's just going to be the case going forward. Every day, you're going to have 10,000 baby boomers retiring. So that means we're left with a smaller, younger, and less experienced labor market. So young people are smart, but if you're young, you have only but so much experience because you haven't lived that long. So that's a challenge for the US. And we think that's going to be a challenge to growth going forward. So this is basically our forecast for growth over the next 10 years. So we have 2 5-year increments. So if you go back to your Econ 101 class, growth or GDP is made up of capital, labor, and productivity. So you can see that the labor, which are the dark blue line, the very light blue bar, is pretty small. And that's because we have this aging labor force. And so we're going to have to make up for it with productivity, right, which is the green bar. And since I have 3 minutes and 36 seconds, I promised you that I would end on a happy note. So we're going to skip over the CRE, all the risks. Okay, I'll let these guys talk about CRE. We won't talk about deficits or labor shortages because I already mentioned it. But, one of the solutions to labor shortages is automation. Yay, this group, this is awesome, right? So, and we did a survey of executives and we asked them, how are you going to generate growth in the next 3 to 5 years? They said digital transformation, including AI. That's awesome. Invest in innovation, people, processes, and tools. And then we even asked them, what do you think about AI in terms of improving the business? And overwhelmingly, they said we've either adopted AI or we plan to adopt it. And when we asked them why, or what do you think AI is going to do? For the most part, they said it's going to do awesome things. It's going to make our people, our companies more productive. There's going to be more innovation, more creativity. And certainly at least 2/3 of them say it's going to increase the bottom line. It's going to bring in money and revenues. That's great. In terms of downsides and challenges, most of the top things that they're concerned about are just, well, we're gonna have to invest in this, and you can look at that positively or negatively, right? But either way, you need to invest in order to take advantage of AI. So overwhelmingly, they're excited about AI and they're planning on using it. So that's perfect for this group right here. So I don't know if I showed this last year, but anyway, we did this analysis and we said, okay, well, how is AI going to help out the labor market, right? We have labor shortages and companies are looking for productivity and growth, right? So we borrowed this analysis and you can see that the light blue bars are things that AI can do very well. The dark blue are things that AI can't do so great in terms of replicating tasks that human beings do. And so we took that and we said, well, what's the risk of AI impacting your job in some way? That could be positive, like it makes you more productive, or negative, it takes your job away, or doesn't do anything, right? And so we lined up all of the different companies, and not surprising, the likelihood that AI is going to impact your job is the highest for technology jobs. So I think for many of your jobs and for the companies that you work for, it's going to be a good thing. It's going to make your workers more productive. All the things that were exciting that executives say that it's going to do, right? And then as you go down, so basically the little white dot is a median occupation in that blue range of occupations for that particular occupational group. And so you keep going down the line. We'll go to the next chart all the way to the other end of the spectrum, where it's basically jobs where you have to show up for work. AI cannot help you. And I always have this vision of being flipped over like a pancake in a hospital by an AI robot. That's not going to happen. So the thing is that AI certainly is going to be a really big thing for the US. Indeed, 45% of jobs are going to be impacted by AI in some form or fashion. And then we look at the individual industries. So a lot of industries are going to be positively impacted. You will have some sectors like admins who may be replaced by AI, but that's going to be an important aspect of companies' adoption of AI, making sure that you're upskilling your workers, retraining them, and repurposing them such that they can use the best technology that's out there to make them more productive. Thanks, everybody.